Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. Mortgage demand just dropped to the lowest level in 5 weeks, even though buyers are still trying really hard to get into this market. Applications are falling, rates are moving back up, and inflation fears are heating up again. Treasury yields continue to climb. But something tells me that buyers are still not giving up on trying to buy real estate in this current environment. In fact, according to CNBC, demand for adjustable rate mortgages, specifically 5/1 ARM loans, is rising as buyers look for creative ways to work around today's mortgage rates. So I want to talk about mortgage demand and how it's overall weakening, but how there's also buyers still desperately wanting real estate. And why I suggest this is because ARM loans are making a comeback. If you remember, they were pretty big back in 2004 through 2007. And we need to figure out, is this a good thing or a bad thing? Well, it starts with the MBA mortgage applications. The Mortgage Bankers Association reported that overall mortgage applications actually fell 2.3% week over week. Purchase applications dropped 4.1%, and the average 30-year fixed rate rose from 6.46% to 6.56%. That interest rate increase, it doesn't sound huge, but psychologically, once rates start pushing that high, after buyers thought relief was coming, well, behavior tends to change pretty quickly. Now, this comes after months of volatility. We've been talking about this now for several shows, right? People were hoping mortgage rates would trend lower in 2026, but that hasn't been the case. It started off that way. But what's really happened in the last 6 to 8 weeks is we've been trending much, much higher. And if you listen to just an episode ago where I mentioned mortgage rates could even get as high as 7%, if not higher at the rate we're going. And why is that? Well, let's listen to what the Mortgage Bankers Association, the MBA, had to specifically point out. And what they said was inflation concerns. They talked about higher fuel costs and growing worries about global public debt levels. It's exactly what we said in just the last episode. So this isn't just my opinion. This is turning into something that everyone is seeing, and it's important because the bond market is starting to question whether inflation is under control long term, which is actually what I mentioned in the last episode. Now, look, here's why I think buyers still want in, though. This is the interesting part of this whole report from the MBA. So while they noted mortgage demand is weak, what they also noted was that these ARM loans are coming back. Now, CNBC put out an article in which they said that demand for adjustable rate mortgages, specifically the 5/1 ARMs, is rising again. Okay, now what's a 5/1 ARM? So in case you're not sure, the mortgage rate for a 5/1 ARM, what it means is this. It basically stays fixed for the first 5 years. So your interest rate, your mortgage rate for the first 5 years, it's not going to change. But after those 5 years, it then adjusts once per year after that. So a lot of 5/1 ARM rates are right now in that, and let me point this out too, they start out lower. This is what attracts buyers to them. Because the first 5 years, right now, in fact, a 5/1 ARM, right now, you get right around the low to mid 5% range. So you could get a 5/1 ARM, and for the first 5 years, your mortgage rate is about 5.15% for that time period of the first 5 years, right? Compared to a 30-year fixed where you're right around 6.2 6.7% right now. So that is a huge difference. That 1.5% difference is big. Now, one caveat is that there are special ARM loan products that include interest-only periods. So those first 5 years could be interest only, which is not good because you're not paying down principal and trying to knock that loan down. But those are different loan structures. They're not the standard 5/1 ARM most people are talking about. So right now, most buyers are in that type where, basically you're getting a 5/1 ARM. The initial rate is lower than the traditional 30-year fix, so it's attractive, right? And so those 5/1 ARMs ticking up is very interesting because to me, it means buyers are saying, look, I still really want to buy something. I just need a way to make the monthly payment work. And it tells you that demand for real estate is stronger than I think the headlines suggest, because if buyers are willing to go around the 30-year fixed rate and try to find another way to make that monthly payment work, that tells you how bad they want to buy real estate. That's what's very interesting about this. Now, I want to point out that, people hear these 5/1 ARMs and they're automatically like, uh-oh, we're going back to 2008. This is how it started. People were getting these loans and we had a housing crash because too many bad loans. And then the interest rate, ballooned and there was a big balloon payment. Uh-oh. Right. But keep in mind, lending standards, a lot looser back then. Don't forget, I always bring this up. I always say, look, verification for income, lending standards. I mean, it was so bad. It was basically non-existent. Okay. I mean, there was so much speculation going on. Everybody was just like, well, the housing market's going up, up, up and away. And so who cares? Give anybody a loan. Give anybody off the street a loan. I mean, that's how bad it got. And people were qualifying for homes that realistically they could never afford. And when prices started to come down, well, guess what? They realized they got to get the heck out of this situation. So you got borrowers today much more qualified. So I do not think this is any reason to be concerned or to even think that we're heading in any situation like that. Now, why would a buyer today take a calculated bet like this? Because remember, after the first 5 years, the interest rate's going to change. Well, I think that a lot of buyers think rates got to fall from here, and within 5 years, they'll refinance. They don't think rates are going higher. They think they're going to fall. They may or may not be right. We don't know. They're probably betting that their income goes up from here anyway. And they definitely are betting on home prices continuing to go up, right? They have to believe, one of those three things in order to continue in this structured loan type. They have to think either rates are coming down and they'll have time to refinance, or their income's going to go up, or home values are going to keep climbing up and they're going to build equity anyway, so who cares, right? But you know what? It goes back to the thing I've been saying too, that I think a lot of buyers, they're just tired of waiting, right? I mean, how many buyers have been on the sideline? How many investors have been waiting 3-4 years for lower prices, lower rates, or a big crash that's never happening? I haven't seen a housing crash, even though a bunch of people called for one, right? Prices are resilient. Inventory's pretty good. Affordability never really got normalized. So they got a workaround, right? They're going to say, okay, well, I got to go for this loan. So it's interesting, look, as far as what happens from here, I think the next move in mortgage rates becomes critical. If we get anywhere near 7%, if we get a 7 handle on the 30-year fixed, it's going to be really tough. I mean, I could see these ARM loans get more in style. Right? More demand for them. That could continue to happen. I mean, we're already seeing it. CNBC is reporting this because affordability is going to get worse. And so if you can get a lower rate initially for the first 5 years and get yourself in the door, become a homeowner, become an investor, whatever it is you want to do, people are going to do it because they want in. They want in. Now, if rates can stabilize or drift lower, that'd be great. Right? Because that tells me there's a ton of sideline demand out there. The fact that 5/1 ARMs are going up tells me there is some real pent-up buyer demand out there. And so I think that tells me also that buyers are mentally adjusted to the environment. and to where prices are right now for real estate, right? And I think the main obstacle for most investors and buyers right now is just the monthly payment. I think that prices right now, people are going, this is just the new normal. The question is, can I afford to do the monthly payment? If I can, I want in. I do want in. Well, it's an interesting thought. We'll see where it goes. But it tells me a lot about buyer behavior. The fact that these loan types and these loan instruments are going up tells me a lot about buyer psyche, buyer behavior, and the fact that, listen, they want in. They want to get into this housing market, and they'll do what it takes to get in. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at the Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free. Get exclusive bonus episodes and content, and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.